While Chinese mainland markets ticked higher on their last day of trade for 2023, it was an upbeat end to a difficult year. Both the major Shanghai and Shenzhen indices are ending the year below key psychological levels, the Shanghai Composite below 3,000 points and the Shenzhen Component below 10,000. These are levels that the markets have been fighting to maintain in the second half of the year when China's post-COVID economic recovery started showing signs of being a long and drawn-out process. The CSI 300, which tracks China's blue chip stocks, was one of the worst performing global indexes this year, shedding 11.4% over the course of 2023. International investors have been a bit hesitant to buy Chinese A-shares as well, with net buying on the Stock Connect links totaling only around 44 billion yuan or $6.2 billion US dollars. Sounds like a lot, but it's the smallest annual inflow since 2015, and it's been dented by some heavy selling in the second half of the year. But that's not to say there have been no winners among the traditional sectors and the new. Chinese oil giant PetroChina has seen the benefits as turmoil in Ukraine and the Middle East pushed crude prices higher. Its stock ends 2023 up more than 40%. It's also been a year of tech tension between China and the United States, as Washington has sought to restrict China's access to high-end semiconductors, particularly the ones that can be used to develop and train AI. That will leave Chinese chip makers to try and fill the void, and their stocks have been rising. Shares in China's biggest chip producer, SMIC, are up almost 30% this year. Hong Kong's Hang Seng was Asia's worst performing stock index this year and finished the last trading day of 2023 flat. It's followed a similar trajectory to the Chinese mainland markets, and its big name tech listings have suffered due to persistently high inflation and interest rates around the world. Tech stocks and other so-called growth stocks tend to be far more interest rate sensitive than traditional sectors, and if you like low interest rates, this hasn't been your year. If you were tracking the Nikkei 225, it definitely has been your year. The Japanese markets put on a stellar performance in 2023, with the Nikkei 225 gaining 28.2%, its best year in a decade. We saw the index repeatedly hit 33-year highs as Japan's long-running problem of low inflation seemed to finally be conquered, and speculation rose about an end to the BOJ's ultra-loose monetary policy. Japanese markets were also helped along by a fairly weak yen. Many Japanese listed firms make a fair amount of money outside of the country and need to repatriate that income. If the yen is low, those yen-denominated profits look even better. And there were even some high-profile statements of confidence in Japanese business, most notably Warren Buffett's Berkshire Hathaway moving to increase its stake in Japanese firms. So it's been a year with some very clear winners and losers, and Chinese and Hong Kong markets are certainly ripe for a rebound in 2024.